Your books say you made $80,000 this year. So why is there only $400 in your bank account? If you've ever stared at a profit number that looked great and a bank balance that looked terrifying and wondered which one was lying to you, here's the good news. Neither one is lying. They're measuring two completely different things. You've gone out there, you've done the work, you've sourced clients, you've made sales. But sales do not automatically create cash. A business can look successful on paper while quietly running out of money. It's one of the most confusing and most dangerous problems an owner can face. In this video, we break down the 6 reasons profit and cash drift apart, how to find which one is happening in your business, and the 5 steps that can fix it. Welcome to The Solvent Owner, where we help business owners understand their numbers, protect their cash, and build financially stronger businesses. Let's start with the distinction that explains almost everything. Revenue is what business earns from selling products and services. Profit, on the other hand, is what remains after subtracting your recorded expenses, while cash is the actual money sitting in your bank account right now. These are 3 different numbers answering 3 different questions. Your profit and loss statement asks, did I earn more than I spent over this period? While your bank account asks, what is actually here today? So when profit is high and cash is low, it is almost always one of 6 things quietly moving money around behind the scenes. Let's name all 6. Reason number 1, your customers have not paid you yet. The first reason is the big one. You got paid on paper, but not in real life. You completed the work, you sent the invoice, your books recorded the sale the day you earned it, so your profit went up immediately. But then the customer has not yet paid you. Say your business books $20,000 in sales this month, but $15,000 of that was invoiced on 30-day terms. You earned $20,000. Only $5,000 entered your bank account immediately. Meanwhile, payroll, rent, and vendors are all due now. That timing gap is the single most common reason growing businesses run short on cash. And it gets worse when invoices go out late, terms are unclear, or nobody consistently follows up on overdue balances. A growing receivables balance makes revenue look strong while cash gets weaker. A lot of business owners don't like chasing unpaid invoices, but I can tell you right now, this right here is why chasing unpaid invoices is not annoying admin work. It is the difference between profit on screen and money in your hand. Reason number 2, you spent the cash before the sale was finished. The second reason, the money left before revenue arrived. This hits product businesses, construction companies, agencies, and any service business with real upfront costs. You buy inventory, materials, advertising, or subcontractor time before the customer pays you. When you buy $10,000 of product, that cash leaves your account immediately. But your P&L does not count it as an expense yet. It sits as an asset, stuff on a shelf, until it actually sells. So your profit looks untouched while 10 grand walked out the door. Your money is not gone. It's just wearing a different costume in the back room. And this is the same pattern that we see with project work. You might spend $8,000 preparing to deliver a project that will eventually bring in 12. On paper, very profitable. But the business has to survive the gap between paying the 8 and collecting the 12. Stack a few of these projects on top of each other, and you can run out of cash while every single job is expected to make money. Reason number 3, cash that leaves without touching your P&L. The third reason catches almost everyone. Some of your biggest cash outflows never show up as expenses at all. Let's start with loan payments. When you make one, only the interest portion counts as an expense on your P&L. The part that pays down what you actually borrowed, which is the principal, does not even appear there. So if you pay $2,000 a month and $1,500 of it is principal, that $1,500 leaves your bank account every month while your profit number never feels it. Real cash out, but invisible on the P&L. Owner draws work the same way. A draw is not a business expense. It is you taking your share of profits out of the business. So it reduces your cash, obviously, but it does not reduce the business's reported profit. It is entirely possible to look at $80,000 in profit, but then you forget that you'd pulled out 60 across the year and wonder where it all went. Of course, it went to you. That is the point of the business. You just have to account for it when you read the numbers. And then you've got taxes. If the business is not regularly setting money aside, the bank balance can look healthy, while some of the cash already belongs to a future payment. Note that Rain Financial does not provide tax services directly. For estimated taxes or for tax planning, work with a qualified tax professional, or if you'd like, we'd be happy to refer one. Reason number 4, the big things you bought. The fourth reason, trucks, machines, computers, equipment. Buy a $30,000 piece of equipment and all 30 grand leaves your account at once. But your P&L does not take the hit all at once. It spreads that cost across several years, a little each year. That is depreciation. In year 1, your profit might only reflect $6,000 of the purchase while your bank account felt the full 30. A $24,000 gap. Completely normal. But if you don't know it's happening, it feels like the money vanished. Reason number 5. Your margins are too thin. The fifth reason is different from the previous 4. Those were timing problems. This one, on the other hand, is a math problem. Your business can have impressive revenue and still keep almost none of it. $100,000 in annual sales sounds strong, but after labor, materials, subscriptions, rent, insurance, and marketing, maybe $3,000 remains. A lot of activity, yet very little financial breathing room. Sometimes that is underpricing. Sometimes expenses creep up while prices stay flat. Other times, a service takes far more labor than anyone estimated. These are things that happen in everyday business. And sometimes owners are so focused on making sales that nobody checks what each sale actually contributes. Here is the important part. More sales do not fix a weak margin problem. More sales can make it worse. Reason number 6, you're growing too fast. I know that this one sounds like a contradiction. Your business might be growing too quickly. You might be asking yourself, what's he on about? More sales means more money, doesn't it? But it's not always the case. Do you have the capacity to take on more? Growth requires cash before it produces cash. You need to hire, you need equipment, you need more inventory, you need advertising, you need a bigger space. All of it creates immediate cash demands in exchange for future revenue. Let me give you an example of a client that we onboarded a while back. They came to us at a time when they were experiencing real growth, but they were still struggling with cash flows. It was a service business that was seeing a major jump in demand. Revenue climbed every month, and the owner assumed the business was getting financially stronger. But new employees had to be paid every 2 weeks, while many customers took 45 to 60 days to pay their invoices. The business was profitable on paper, and every new customer made the short-term cash shortage worse. So the problem was never a lack of sales. The real problem was the timing between paying employees and collecting from customers. So what did I recommend? I recommended tighter payment terms, deposits before work begins, consistently following up on invoices, and a rolling cash flow forecast. Don't get me wrong, growth is good, but unmanaged growth, on the other hand, can bankrupt an otherwise successful business. Notice the pattern. Every one of these is a place where cash and profit go their separate ways, and most of the time for reasons that are completely fine. Your business is not broken. Your P&L was simply never built to answer the question, how much cash do I have? That was never its job. So how do you find out which one of these is happening in your business? Let's start with 5 questions. How much money do customers currently owe you? How long does it usually take for them to pay? Which expenses have increased in the last 3 to 6 months? How much cash is leaving through debt payments and owner withdrawals? And how much cash will the business need over the next 8 to 13 weeks? If you can't answer these quickly, your bookkeeping is not giving you the visibility that you need. Here are the 5 steps that can fix that. Step number 1. Review receivables every week. Don't wait until month end to look at unpaid invoices. Pull your accounts receivable aging report every week. What you're looking to identify is what's approaching due, what is already late, and which customers habitually pay slowly. Once you have this information, you want to send out invoices promptly and follow up consistently. The longer an invoice sits, the harder it gets to collect. Step number 2. Fix your payment terms. Your business should not be financing the entire customer relationship. Depending on your industry, it's perfectly okay to require a deposit, use milestone payments, shorten your terms, or even keep a valid payment method on file. A project with heavy upfront labor or materials may justify a 30 or 50% deposit before work begins. The right payment structure shrinks the amount of your own cash that you float while waiting to get paid. Step number 3. Build a cash flow forecast. There is a report built exactly for this problem. The cash flow statement takes your profit and adjusts for all of it. The invoices, the inventory, the loan principal, the draws, the equipment, and shows you exactly where your cash went. Then I'd like you to look forward. List the cash you expect to receive each week, and the payroll, the rent, the vendor payments, the loan payments, subscriptions, and taxes going out. The goal is not to predict every dollar perfectly. The goal is to spot the weeks where the business runs short, and you want to do that early while you still have options. Then you follow up on receivables. You can delay a non-essential purchase. You can shift payment timing, cut an expense, or make a financing decision before it becomes urgent. Profit tells you whether the business works. Cash flow tells you whether you can make payroll on Friday, and you need both. Step number 4. Stop managing from your bank balance. Your bank balance tells you how much cash exists in a single moment. It's a snapshot. It doesn't tell you which bills are coming due, which deposits are customer prepayments, how much is owed in taxes, or how much customers still owe you. A real financial review includes your profit and loss statement, your balance sheet, your receivables report, your payables report, and a cash flow forecast. Your bank account is a part of the story. It's not the only story. Step 5. Keep your books current. So everything we've discussed here so far, none of this works if your bookkeeping is months behind. Late or inaccurate books make it almost impossible to tell whether your problem is slow collections, rising expenses, weak margins, debt, or withdrawals. So you end up trying to guess which is the one thing you cannot afford to do. Current books let you catch trends before they become emergencies. You should be able to say at any point in time what the business has earned, what it has spent, what customers owe you, what you owe others, and how much unrestricted cash is actually available. If you want the simplest possible starting point on this, once a month, put 3 numbers side by side: your profit, your bank balance, and a list of unpaid invoices. Just seeing those 3 together explains most of the mystery. 10 minutes. That's all it takes. That is the beginning of running your business by the numbers instead of by your gut. Having sales but no cash does not mean your business is failing. It means something in the financial system needs attention. Your cash may be trapped in unpaid invoices, or it may be tied up in inventory or project costs. Your margins may be too thin, or your debt payments, draws, or taxes may be consuming more than you realize, or growth may be spending money faster than customers are paying you. The sooner you identify the root cause, the more options you have. If your books are behind, your accounts are not reconciled, or you're struggling to understand where your money is going, please feel free to click the link below to book some time so we can go over your finances. No pitch. We look at what's happening in your books and tell you straight what you're dealing with. And if this content was valuable to you, please subscribe to The Solvent Owner for practical guidance that helps you understand your numbers, strengthen your cash flow, and build a more financially stable business. Your profit is not lying to you, and neither is your bank account. They're just 2 different tools, and now you know how to read both.